There is one major thing that separates the rich from the poor, or those who want to become rich but never hit that goal. This key thing is that the rich use other people's money to build wealth. Here are some famous examples. Bill Gates. Bill made a huge chunk of his $90 billion fortune from Microsoft stock's valuation. And for those who know the basics of stocks understand that a stock's value is derived from how much another party or investors are willing to pay for it. So, for Bill Gates, all he had to do to accumulate such a fortune was to create a company, Microsoft, make the company a valuable commodity attracting investors, other people's money, then later list the company's stocks on the stock exchange for retail investors to invest in, making his shares more valuable. And in such a simple process, within a decade, he was able to convert some lines of code he was writing in his bedroom to over $1 billion by integrating his knowledge with investors' funds. This strategy has been used by 85% of all billionaires, since not all of us can write code or we have zero interest in programming. There are other examples of multimillionaires, such as Ben Malla and Manny Cosbin, who used other people's money to build a combined $400 million empire in less than 2 decades. With both starting from poor backgrounds, Ben being the son of a broke and abusive mom, and Manny being the son of a poor immigrant. Other people's money is a fundamental concept of being rich, and it is a sign of high financial intelligence. By using both good debt and other people's money, you can dramatically increase your return on investment, and you can even achieve infinite returns. By definition, good debt is any debt that puts money in your pocket. By contrast, bad debt takes money out. So, a car loan, for instance, is bad debt. You pay for it each month while the car provides no income and depreciates once off the lot. Good debt, by contrast, would be a loan for an investment property where the rental income pays for the expense of the property, including the debt service, while also providing monthly income. The downside to good debt is that you can generally only borrow a certain percentage of an asset's purchase price. For example, in terms of real estate, that is generally around 70 to 80% of the purchase price. To break this down, let's use an example of a $100,000 property for simplicity's sake. In a traditional deal with a bank, you can only borrow around $70,000 to $80,000 towards the property. The rest of the money must be made up of equity from another source. And this is how the two, Ben Malla and Manny Cosbin, have accumulated 80% of their fortune. Similarly, you have two choices when you find a worthy investment. Use your own money or use other people's money for the equity needed above and beyond the loan. Provided you structure the deal well, the more you can use other people's money, the higher your return will be. In the case of our real estate example, let's run a few scenarios. Scenario 1. The property's purchase price is $200,000. The bank finances 80% of the property's value, that is a $160,000 loan at 5% interest, while you provide 20% of your money for equity, that is $40,000. Running through a simple mortgage calculator, your annual cost for this loan would be about $17,000. Assuming you have an income from the property of $22,000 a year, after expenses are paid, your total net income would be $22,000 minus $17,000, which equates to $5,000. And your return on investment for this would be $5,000 divided by $40,000 equals 12.5%. Also, you will be building equity in the property. Scenario 2. A property's purchase price is $200,000. The bank finances 80% of the property's value, that is a $160,000 loan at 5% interest, while you need to provide a 20% deposit for the equity. Instead of raising the money from your account, you use other people's money at a 7% interest rate. You then get paid 50% of net operating income as the finder of the deal. In this case, your annual loan costs would still be $17,000, but you'd also have an additional cost of around $3,000 for the other people's money you borrowed for equity, based on an assumed 7%. So, your total bank loan and other people's money costs would be $10,000. Again, assuming you have an income from the property of $22,000 a year, after expenses are paid, your total net income would be $22,000 minus $10,000, equating to $2,000. Your fee for putting the deal together would be 50% of the NOI, in this case 50% of $2,000, which is $1,000. In such a deal, your return on investment for this would be infinite because you're making $1,000 without any money in the deal. These, of course, are just small numbers, for example. In the real world of investment, you can do this at scale and make massive and infinite returns. But it takes high financial intelligence to do this, so subscribe to the channel to gain it. Now, many people think it's a fantasy world that people would just give you money to invest, but that couldn't be further from the truth. The reality is that most people don't have time to find good deals. Instead, they rely on people with the proper financial education, skill set, and drive to bring deals to them. Take an example of real estate investment trusts, better known as REITs. They use this exact system to make millions, if not billions of dollars. Obviously, as there are a lot of legal matters involved, it is advisable to practice this system as an LLC rather than in your own name. You will do all the hard work of finding deals, doing the due diligence, negotiating with owners and lenders, and handling management. In return, people line up hoping to invest their money with you. As I mentioned earlier, you can use this system to substantially increase your returns and secure even more assets at scale. Let's use another example of how that works. Let's say that you have $100,000 to invest. You could use that to put down 20% on 5 properties. But using the concept of other people's money, you'd rather use those $100,000 to put down 5% on 20 properties. You can do this by finding 20 great deals and lining up investors to invest in them. Here's how the math works out. The bank would lend $80,000 for each property, and you would divide your $100,000 into $25,000 segments, using other people's money to raise the other $15,000 needed for each property. Again, at 5% interest, the payment on the loans would be around $500 per month. Let's assume that you'll pay a little more for our investors' money and give them 7% interest. The money owed to them would be a little less than $100 per month, but we'll go with $100 to make it simple. So your total costs would be about $600 per month. That means we'll have a cash flow of about $200 per month, which will split with our investors 50/50. You will then pocket $100 per month, or $1,200 per year, and your investors will pocket $100 per month, or $1,200 per year. Adding up the total return for all 20 deals, that's $24,000 per year in cash flow, a return of 24%. Not only are you making 6% more per year than if you just used your money, but you also have ownership in 20 assets instead of just 5. Later, you can refinance these properties, pay off your investors, get you investment back, and continue to receive cash flow from the 20 properties, an infinite return. Also, not only do rents rise to keep pace with inflation, they are a primary driver of it. That means you don't have to worry about inflation sapping your returns as time goes by, as you do with bonds. Imagine you buy a bond paying 5% annual interest. If inflation runs at 2%, then your real return is only 3%. In most cases, your rental cash flow and cash-on-cash returns rise over time, especially if you use leverage. Also, the returns are predictable. For example, when you buy an index fund, you hope for the best based on average historical returns. But you don't just hope for the best when you buy a rental property. If you calculate the cash flow right, you know precisely what return it will earn you over the life of the building, with most buildings tending to last over 70 years with only little maintenance. With real estate, you also know the purchase price, you know the market rent, and you either know or can accurately forecast all your expenses. For instance, you know the property taxes, the cost of rental property insurance, and the cost of property management. You know the vacancy rate in the neighborhood. You can forecast the average annual maintenance and repair costs accurately. That means you never have to make a bad investment if you run the cash flow numbers accurately. As a disclaimer, I'm using very simple maths here. In real life, the numbers are more complicated and much larger. But the principle and backbone of the system are the same. Investing with other people's money takes a high level of financial intelligence. But you can start small and work into bigger apartment deals. So be diligent. Continue to increase your financial education, work hard, and master the fundamentals of good debt and OPM, and you will become wealthy. And you could do all that by subscribing to this channel.